The market has officially closed for the day on Wednesday, January 14, 2026, and Datavault Inc., trading under the ticker DVLT on the NASDAQ, finished the session at a price of 0.71 USD. This represents a significant decline of 0.087 or 10.86% from the previous session. While a double-digit drop in a single day often sends retail investors into a panic, there's a much more complex story happening beneath the surface of this ticker. Many traders looking at their Robinhood app or checking their individual brokerage accounts might see this as a sign of failure, but the reality is that we are witnessing a massive transfer of ownership and a fundamental shift in how the market values data-centric companies. Most people expect a stock to tank when a major shareholder dumps millions of shares recently. However, the reality that many are missing is the aggressive expansion of the actual business infrastructure that Datavault is building, while the stock price is being suppressed by technical selling pressure. If you are currently managing your own portfolio through online investing or using tools like Schwab Intelligent Portfolios, you know that price action doesn't always reflect the underlying value of the tech. While high-flying names like NVIDIA stock or Apple stock dominate the headlines with their trillion-dollar valuations, smaller players like DVLT are operating in the trenches of data monetization. The common belief is that Datavault is just another micro-cap AI play struggling to keep its head above water. The contrarian view, however, is that the company is successfully building a physical and digital network that most investors haven't even begun to price in. Just today, the company announced a major integration with fintech.tv to launch a patented AI rating system. This isn't just a press release, it is a move to create a standard for media transparency. When you look at your Fidelity mobile app and see a stock down 10%, your instinct is to look for the exit, but smart investors are looking at the volume. We saw massive trading volume today, far exceeding the 30-day average, which suggests that while some are fleeing, others are stepping in to absorb the supply. The recent movement in Datavault AI has been nothing short of a roller coaster. If you've been tracking this on the Interactive Brokers trading platform, you've seen the stock struggle to hold the 1.00 level after a brief surge earlier this month. That surge was driven by news of a 100-city expansion plan for their edge data monetization network. Then the hammer dropped with the Silex disclosure. Seeing a major partner sell 14.7 million shares between 1.07 and 1.37 is a bitter pill for any bull to swallow. It creates a ceiling on the price because every time the stock tries to rally, there is a massive block of shares waiting to be sold. This is the tension between expectation and reality. The expectation was that Silex would remain a long-term strategic anchor. The reality is that they needed liquidity, and their exit has created a temporary vacuum in the stock's price support. For those using SoFi Active Investing, this is a classic lesson in institutional tailwinds versus headwinds. When the big players move, the retail crowd gets caught in the wake. Let's talk about what Datavault actually does, because the business model is frequently misunderstood. They aren't just an AI software company, they are essentially building the plumbing for the next version of the internet. They focus on data valuation, monetization, and credentialing. Think about it this way. Companies have mountains of data that they don't know how to price or sell. Datavault provides the tools to turn that raw information into a tradable asset. Their information data exchange and platforms like DataScore and DataValue are designed to assign a real-world price tag to data. They even have a division focused on acoustic science, which came from their previous identity as YSAW Technologies. This mix of high-end audio tech and blockchain-based data management makes them a bit of a hybrid. They are working with IBM's Watson X platform to deploy enterprise-grade AI at the edge. This means processing data closer to where it's generated, like in a retail store or a hospital, rather than sending it all to a central cloud. For anyone doing self-investing through a Fidelity brokerage account, understanding this distinction between cloud AI and edge AI is critical for the next few years of market growth. The financial targets being thrown around by management are staggering. CEO Nathaniel Bradley recently raised the 2026 revenue guidance from $50 million to $200 million. That is a 400% increase in expectations. When a company with a market cap around $400 million tells you they expect to do $200 million in revenue next year, the market usually reacts with skepticism. That skepticism is reflected in the current 0.71 price. The reality is that if they hit even half of that target, the stock is currently trading at a fraction of its potential value. But there is a high execution risk. Building a 100-node network across the United States requires capital, partners, and flawless technical deployment. They are betting big on their Sanctum AI units to provide national security-grade cybersecurity for these data exchanges. If you're checking your Robinhood crypto or stock balance daily, you know that small-cap execution is where dreams go to die or where fortunes are made. There is no middle ground here. Institutional activity has been a mixed bag. While we saw the Silex sell-off, we've also seen new stakes being taken by firms like Anson Funds Management and Vanguard. This shows that the smart money is divided. Some see a struggling penny stock, while others see a ground floor opportunity in a fragmented industry. The short interest is also something to watch closely. At over 16% of the float, there is significant pressure from bears who think this expansion plan is more talk than substance. However, high short interest can also lead to a squeeze if a major catalyst hits. For those who use Interactive Brokers' fees and platform features to track short interest, you know that a sudden spike in positive news could force those shorts to cover, leading to the kind of parabolic move we sometimes see in Tesla stock during its more volatile periods. Comment below how many shares of Datavault Inc. you currently hold, or if you are waiting for it to find a bottom before you jump in. It's important to get a sense of where the community stands on these high-risk, high-reward plays. Looking at the broader macroeconomic picture, companies like Datavault are operating in an environment where interest rates and tech spending are in constant flux. If you are seeking investment help or using investing sites to research your next move, you have to weigh the risk of a small-cap company against the stability of something like Fidelity ETFs or Fidelity mutual funds. Datavault is burning cash to grow. Their latest filing showed a net loss, which is expected for a company in a heavy expansion phase, but it means they are reliant on financing. They recently secured a $150 million strategic investment agreement, which is supposed to provide the runway they need. But in the world of online investing, a signed agreement isn't the same as cash in the bank until the shareholder vote passes and the funds clear. This is the reality that often clashes with the expectation of a smooth growth story. The future outlook for DVLT hinges on their ability to monetize their patents. They have an extensive portfolio covering everything from AI-driven monetization to immersive audio. Their partnership with fintech.tv is a pilot program running through April. If that pilot shows that viewers engage more with content when they can see a real-time bias meter or participate in interactive polling via ADIO technology, it could lead to a massive rollout across other media networks. This is the hidden value that doesn't show up on a simple stock chart. You have to look at the utility of the tech. While you might be more comfortable holding SoFi stocks or looking for stability in a Fidelity wealth management plan, the potential for a 10x or 20x return usually lives in these types of overlooked infrastructure plays. To summarize, the central insight here is that Datavault AI is currently in a period of intense price discovery. The expectation was a smooth ride towards 2026 revenue targets, but the reality of major shareholder selling and technical resistance has created a deep discount. The company is fundamentally changing its scale, moving from a small audio tech firm to a national data monetization powerhouse. The 10.86% drop today is a reflection of short-term liquidity needs from big holders, not necessarily a failure of the business model. However, the risks are real. The cash burn is high, and the competition in the AI space is fierce. If they can execute on their 100-city rollout and hit that $200 million revenue target, the current sub-$1 price will look like a historical anomaly. But if they stumble on the deployment or fail to secure the next round of funding, the bears will be proven right. For those of you using a SoFi robo-advisor or a Fidelity trading platform, it's easy to overlook a stock like this because it doesn't fit into a standard safe bucket. It requires a different level of research and a stomach for volatility. Whether you are using Interactive Brokers trading tools or just scanning the Robinhood Investments tab, you have to decide if you believe in the infrastructure of data or if you think the AI hype has peaked. The contrast between the ambitious press releases and the bleeding stock price is exactly where the opportunity or the trap lies. Datavault is building in the dark, and soon enough the results will have to speak for themselves. In the meantime, the market will continue to be a battlefield between those who see the vision and those who only see